In this video, I want to highlight 15 major disadvantages of a concentrated portfolio, a focused portfolio. I had earlier talked about, the advantages. This time around, I want to highlight the disadvantages. Number one, higher risk. Higher risk. And this higher risk is as a result of increased volatility. A concentrated portfolio is more susceptible to significant swings in the value of your investment due to what? Due to heavy exposure to a few stocks or to a few sectors. If you are invested in a few stocks and it is concentrated in a few sectors, if those sectors are affected or if those stocks are affected by market dynamics, fluctuation, volatility, then of course you're incurring a higher risk. If the market goes down, your investment value would equally nosedive. Number two, lack of diversification. In other words, your risk is not adequately spread out, limited spread of risk because of lack of diversification. And so concentration means less diversification, increasing the risk of substantial losses if one or more of the concentrated investment performs poorly. Imagine buying, let's say, just 5 stocks, and then 1 or 2 performs poorly. The impact on your portfolio is better imagined than experienced. So that lack of diversification is a key disadvantage of a concentrated or a focused portfolio. Number 3, sector or industry vulnerability. Sector or industry specific risk. So exposure to sector specific risk. Concentration in a particular sector or industry exposes the portfolio to sector specific downturn or adverse effect. If a given sector is experiencing difficulties and you are concentrated in that sector, of course, you can imagine what will happen to your investments. And different sectors pass through different level of risk at any given time. Just like in the pandemic, during the COVID-19 pandemic, the airline sector suffered the most. Airlines were grounded, no flights, like that. But companies like online retailers like Amazon, like Zoom, they did very well. That is why, when it comes to concentration, the risk there is can be very high. Not only that, number 4, potential for large losses. There is that potential for large losses. So impacts of negative events, a poor performance by a concentrated stock or sector can lead to significant financial losses impacting the entire portfolio. So there's always that risk of losses, because of concentration. If a sector takes a hit, then it's going to affect your investments, in that sector, in those sectors as the case may be. Number 5, limited growth opportunities. In other words, you miss opportunities in other sectors because you are concentrated in a few sectors. So if focusing on a few stocks, might mean missing out on growth opportunities in other sectors or in other emerging markets. If you are focused in a sector that is not growing, that means the opportunity cost is that you are losing, in sectors that are growing rapidly, because you are concentrated in a sector that is not growing, as high as expected. And not only that, number 6, increased market risk. There is that increased market risk because of sensitivity to market movements. So a focused portfolio may be more sensitive to overall market movements, leading to a greater level of risk and a greater level of volatility. It's a key disadvantage you must take note of. You are more sensitive to market fluctuation compared to even your stock is you have a larger number of holdings in the market. Number 7, difficulty in rebalancing. Difficulty in rebalancing. Complex adjustments. Adjusting or rebalancing a concentrated portfolio will be challenging, particularly if it requires selling large portion. So in this case, let's say you have let's say $1 million, and you have 5 stocks. Assuming you spread your investment evenly, that is $200,000 per stock. All right, that's a larger holding per stock. In a case where you have to rebalance this portfolio, let's say you have to rebalance 2 of them. That means you're going to sell about 40% of your stake to 200,000 per holding. For the 2 holdings, 400,000, that's 400%. That's 40% of your holding. That's is delicate, it's dicey actually. So rebalancing that kind of portfolio is somewhat is difficult. Number 8, liquidity concern. There could be difficulty in selling. If concentrated holdings are less liquid, it may be challenging to sell large quantities without affecting the stock price. If in the stocks you are concentrated on, and let's say 1 or 2 are illiquid, then how do you go about selling them? You cannot really sell them easily. So it's going to affect the entire portfolio, portfolio performance. Number 9, emotional investments. That's overconfidence risk. Usually it will take a high level of confidence for you to be able to concentrate in a focused portfolio. And so investors may develop an emotional attachment to their concentrated holdings, leading to biased decision making and reluctance to sell underperforming assets. You are so confident in your holding to the point when the stock is underperforming, you find it very difficult to even sell your stocks because of the overconfidence level you have in the stocks in your portfolio. It's a very huge disadvantage. Number 10, potentials for higher transaction costs because of frequent trading costs. Focused portfolio may require more frequent trading to adjust positions, leading to higher transaction costs. It might become necessary you trade frequently because you want to adjust your portfolio, you want to rebalance your portfolio. That frequent trading will equally attract what? It will attract transaction cost. Number 11, increased monitoring requirement. More intensive oversight. Concentrated for portfolio requires more frequent monitoring and analysis to manage risk effectively, demanding more time and more efforts. That's clear enough. Number 12, volatility from market events. That is this higher sensitivity to market trend, to news, in the market. And so focused portfolio may be more affected by market news or events that impacts the specific stocks or sectors you are invested in. And so you have a few sectors you are invested in. So news will certainly, impact those sectors, and that will then lead to a kind of volatility because of the market events your portfolio have to react to. Number 13, tax implication. Tax implication. We can't run away from taxes in the market. It's part and parcel of what makes up, a vibrant stock market. Capital gain taxes, selling concentrated positions may result in substantial, capital gain taxes, particularly if they have appreciated significantly. Let's say you have a few stocks and one or two appreciate significantly and you have to sell. because of the huge appreciation, you will be taxed at a higher rate. No, it may be a normal rate, but because it could be a normal rate of taxation, but because of the fact they are selling huge positions, so you are going to be taxed. The value of the tax you're going to pay will be very high compared to if you are vastly diversified. So that capital gains tax is there, and you'll be taxed, a large amount of money because you are selling few or a single concentrated position. Number 14, economic downturns will greatly impact your portfolio. So economic downturns or financial crisis can disproportionately affect a concentrated portfolio, leading to more severe losses. Like what happened during the 2008 financial crisis. You discovered that banks and real estate companies were the most affected. They were the most affected. So because of an economic downturn, if you are invested in those sectors as at that time, you will incur, more losses compared to other less affected sectors. It's like investing in the dot com sector during the dot-com boom and bust. During the bust, season, of course, it's going to affect your investment negatively if you be concentrated in those areas. Please subscribe to this channel and don't forget to give me a thumbs up, press the notification bell, and drop your comment in the comment section. Number 15, lack of long-term stability compared to a diversified portfolio. The stability that is obtainable, in other kind of portfolio may not be obtainable in your own. And so focused portfolio may be less stable over the long term compared to a diversified portfolio, potentially affecting long-term, financial goals. If you are invested in maybe 50 companies, you have a more stable portfolio, a smoother returns than investing in just 5 stocks, running a 5-stock portfolio. The volatility is much compared to that of a more diversified portfolio. That is what we need to understand when it comes to this. But essentially, me personally, I'm still naturally attached to running a concentrated portfolio. It's a matter of individual differences and our risk tolerance. I prefer a concentrated portfolio compared to a diversified portfolio.